what most of you didn't see coming was this change in tact from gradual to, we're going up. And give us your kind of take on that shift.
Yeah, that was the big surprise, not the rate movement, but the Reserve Bank changing its forecast for when interest rates will peak from the middle of 2024 till the middle of 2023, saying we're going to get this done more quickly than we thought, and lifting their projected peak for the official cash rate from 3.4% to 3.9%.
Welcome back to Tea with Tony. This month, we ask if the global economy, and therefore little old New Zealand, is in for a case of long COVID. Are we heading into recession? And could that be what's needed to reset the baseline? And of course, we dig deeper on inflation, interest rates, and the housing market. Hello, Tony. How are you?
Good, thanks, Lenska. Good to be back here again.
Yeah, nice to see you. So look, let's get straight into it. Has the economy got a nasty case of long COVID coming our way? Everyone seems to be talking about the R word.
Yeah, I'd say not so much recession. Treasury and Reserve Bank aren't predicting it. I'm not predicting it. I'm not aware of anybody who actually is. But there is a bit of a reality check here, I think, underway for, I guess, a relatively long list of reasons. One, there's soaring energy prices and downgrading of world growth predictions. Generally, when energy prices soar, obviously because of Russia's invasion of Ukraine at the moment, generally when that happens, you get world growth slowing down. Supply chain disruptions in some regards are getting worse, with China still following an eradication policy for COVID-19. So shutdowns of cities, wharves, factories, transport networks, etc. That's a negative. Our Reserve Bank is raising interest rates very quickly. And that's exerting some downward pressure. House prices are falling away. Some chickens definitely coming home to roost for home building. I think too many over-optimistic people might have got in the sector, so a few closures happening there. But I think we've got to remember, underlying all of this, the reason we didn't have a Great Depression scenario when the pandemic came along early in 2020 was that governments ran large deficits, including in New Zealand, and central banks, including our Reserve Bank, slashed interest rates and printed a lot of money, successfully avoided the Great Depression scenario, but overstimulated our economies in the process. And we have been on a spending binge, which not a single sane person predicted this time, 2 years or so ago. House prices soaring. We've bought spas and Audi cars, electric bikes, and done home renovations, which you're not going to do if there's a recession coming along. So there's a natural reality check in a lot of sectors out there. But I'm still on the side of probably not a recession as such.
So the message there is reality check over recession.
Yeah, it's a different R. Yeah, I now realise it's a reality check, and especially in the context of, well, actually for a lot of firms, if they had fewer customers to service, that would be really positive because they can't even service with the timeliness of delivery and quality that they want their existing clients, given the unemployment rate. Well, it was 4% going into the pandemic. None of us figured, in 2 years' time, it's going to be at 3.2%. It would have been the most ridiculous forecast anyone could make. But we have staff shortages, more Kiwis hopping across to Australia as well. So for many businesses, a bit of a backing away in customers would actually probably be quite a relief over the next 12 to 15 months.
If there was a recession, is it fair to say that is a bit of a reset of the baseline, and if it's not a prolonged issue, it can have a decent reset in the economy?
I think reset in terms of buying some businesses some time to adjust to a permanent shortage of labour, to more deeply consider the capital expenditure they need to undertake to boost productivity, labour-saving technologies, robots for some sectors, etc. So I think it gives some opportunity for that to be done. But the key one, which us economists are all keeping an eye on, is evidence of inflation not getting into a wage price spiral, that the Reserve Bank will gain some comfort that raising interest rates will not need to have to go so far to deliberately create a recession. And we've got to ask ourselves, could they do that? Well, yes, they did. In 2008, the Reserve Bank created a recession, but that was partly because it took 3 years to get interest rates to high levels. They're getting the job done now within the space, I'd suggest, of about 12 months from October last year. So it's a different scenario.
Right, and that brings us to monetary policy, inflation, interest rates. So they being the RBNZ, have taken a much more aggressive stance on monetary policy. So people like you, our darling economists, saw the 50 basis point rise coming with the last OCR rise. What most of you didn't see coming was this change in tack from gradual to we're going up. And give us your kind of take on that shift.
Yeah, that was the big surprise, not the rate movement, but the Reserve Bank changing its forecast for when interest rates will peak from the middle of 2024 till the middle of 2023, saying we're going to get this done more quickly than we thought, and lifting their projected peak for the official cash rate from 3.4% to 3.9%. These were pretty serious things, and I think partly they did it to regain some credibility because central banks have been somewhat ragged on the past year or so for overstimulating their economies. But there's part of the answer there as well. If we go back just over 2 years ago with central banks looking at a potential depression scenario, they adopted what we call a least regrets policy. What will we least regret getting wrong? And what they decided was we will deliberately take the risk of cutting interest rates too far, keeping them too low for too long, printing too much money, overstimulating our economies, overstimulating inflation, and it is better to take that risk than not ease enough and create deflation, add to deep recessionary environments. So the least regrets policy back then was let's not regret not easing enough. So they eased the bejeebers out of everything, and mission accomplished. They have overstimulated their economies, and so now the surprise from the Reserve Bank recently was they've got a new least regrets policy. It is better now to take the risk of over-restricting the New Zealand economy, raising interest rates too far, too quickly, and crushing growth, but that's the risk worth taking, because if we only go so slowly like they did from 2005 to 2008, they risk inflation becoming entrenched. They risk people like me saying, I think they've given up the ghost on 1 to 3%, and really they might look at 3 to 5% average. They want to avoid that risk completely. And so that's what they're doing now. And you can't forecast when they're suddenly going to adopt a new least regrets policy. So none of us actually feel bad in not picking that they would put the boot down on that monetary policy review.
And am I right in saying the economic consensus has largely been okay? That was fine during COVID. They just didn't pull the trigger the other way fast enough. They didn't come out of very low rates. They left it a bit too long.
That's the consensus, basically. Can't they see what we're seeing? This booming housing market, all this consumer spending out there, strong labour market. Do we really still need a 0.25% cash rate and injecting extra money into the system by buying government bonds? They should have started taking the sugar away early in 2021. They did for home lending by restoring loan-to-value ratios in, I think it was February of last year, and then strengthening them for investors, come May. They should have at the similar time, maybe, who knows, maybe May or so, started raising interest rates as well. And central banks overseas through 2021 repeatedly saying, she's right, we're not going to raise interest rates till 2024, no worries, and now admit, yeah, we should have actually got on the ball a bit sooner. So there is a good part to the story here. I think the interest rate pain is going to be over and done with relatively quickly. Fixed mortgage rates are going to peak probably before the end of this year. You could even get some of the longer term interest rates starting to come down a little bit, 4 or 5 year periods before the end of the year, because they're looking at getting the job done very quickly this time around.
I think you and a couple of the other economists, they're predicting an OCR peak at about 3.9%, which is what you said, which other economists are saying, that's a bit unnecessary. We're thinking about 3.5, and that's subject to change, isn't it? Because it's monetary policy outlooks. But what will that mean? So let's work backwards. 3.9 OCR for a little old Kiwi with a mortgage that's starting to get a little bit twitchy. What does a 3.9% max out look like for a retail rate?
Right. Yeah. First point to make: the Reserve Bank's forecast is 3.9%. Oh, let's call it 4% for the cash rate, given they move in quarter percent changes. The peak, pretty much all of us have, is 3.5%. We don't think they're going to have to go that far, and even their chief economist sort of made a hint about that. Well, maybe they don't need to take the rate that high if they see the restraint in the economy and inflation they want. Before, well, I guess first half of 2023.
And as I've been, but aren't they?
Yeah, it's as I've been pointing out for a wee while now, my monthly spending plans survey shows that we as consumers, we've shut the wallets. We are saying, I'm going to pull back on my spending in the next 3 to 6 months. So I actually do think the thing they want to see happen, crunched consumer spending, is happening, but they'll keep raising interest rates because they do want to make sure the wages growth doesn't take off. That's a key uncertain element when you've got an unemployment rate of 3.2%. But my expectation is 3.5% peak. It'll be reached before the end of this year. That implies for the 2 to 5 year fixed mortgage rates, maybe it's about 0.5% more could go on those rates. For the 1 year fixed rate, probably 1% more. For the floating mortgage rates, you're looking at maybe another 1.25, 1.5% will go on there. But people should take note that with the strong comments there from the Reserve Bank, the extra credibility now being given to them in controlling inflation means that the curve is flattening. You've now got about the bank borrowing cost for a bank out there for lending to you and I is about 3.7% for all of the 2, 3, 4, 5 year terms. Things are flattening out there. And so that's why I say for the medium to long term interest rates, not much further increase, but probably a little bit. Banks have got to still rebuild some margin out there.
And like at this point, we always say, get some good advice. It's so important, and it's not always just about pushing a button on the internet to get the best rate. You've got to structure it based on what your goals are and what you're trying to achieve, and if you're selling a house, if you're not selling the house, and all this stuff. And that's where a really good advisor, as I always say, you can talk to us at NZHL, but you can also talk to other people, and you want someone that's going to lay that all out with you, because the reality of the rates and where they're heading is that for some people, we've talked about what's called a test rate before. So when you've been given your mortgage, it is generally because you can afford it, and you are applied by the lender a test rate. And for many that are on those very, very low rates that are changing out, you are approaching your test rates with the interest rates projected as to where they're going. So you need advice more than anyone, unless you've got it, which if you've got it, good for you. But as Tony and I always say, it's about being reasoned and rational and working it through, because you haven't given the money because you can afford it as well. So it's about playing the long game. So my coaching moment again is over, but I just want to add that in. So Treasury are moving on to inflation, because they're strangely connected. Treasury are predicting inflation will still be above 6% in mid-2023. I was a bit disappointed about that because the cost of my lettuce, but is that realistic? Will the more aggressive stance taken by the RBNZ be able to bring us back sooner?
Yeah, I think we're going to be brought back sooner, given the weakness I can already see in my monthly spending plan survey. My latest survey of real estate agents is showing extra weakness appearing in the residential property market. It's become even more of a buyer's market now over the past 4 weeks. And the pessimism we can see through various business surveys, falling consumer confidence generally. Like I say, I think they're getting the restraint that they want out there. And so, yeah, I wouldn't expect inflation still to be 6% or higher in the middle of 2023, but getting back below the 3% level, we don't have to get to there for the Reserve Bank to actually start cutting interest rates again. I know a few months ago when we talked about this, so you mentioned some people were surprised that we were talking about cutting interest rates. Well, interest rates move in cycles, and the Reserve Bank has just told us they're going to shorten this cycle. The time when interest rates start falling, it's now going to happen sooner than we were thinking previously, because they're really, looking to get the economy crunched as quickly as possible. The uncertain factor is they've explicitly said that the unemployment rate, 3.2%, it's too low. at that sort of level there. There's excess employment in the New Zealand economy. There is a wages risk. So they are looking to raise the unemployment rate in the near future. Where to, we can only really guess at. So there's still uncertain factors sitting there. But for the cost of living strong increase people have seen, there is further to come along, most definitely. But yeah, 6% in a year's time, it seems a bit high to me, quite frankly.
Just on inflation, I've said, could the government's recent budget 2022 and its inclusions like the cost of living payment further stimulate inflation? It felt like a very stimulatory budget, given it is a year away from an election, I understand, Tony. But is that, we always talk about this inflation being, and the government likes to talk about inflation being external to New Zealand. And of course, the Ukraine, the oil prices, all the rest of it. But we always talk about internal factors as well. So what's your take on that budget?
Yeah, mildly stimulatory, but not very much at all. If you're talking about people, I think it was 2.1 million or so people getting $27 extra a week just for a 3-month period, not many people are going to rush out and buy a new car or a couch on that basis. It will help with the weekly grocery bills. And of course, the pressure on prices there is downward. The supermarket chains are highly incentivized not to be putting up prices at the moment, or the government will come down even more strongly than is proven to be the case currently. So I don't think it's all that stimulatory. And we need to note that for the projections Treasury have made for the ratio of government spending to the size of the economy actually going down in future years, and revenue is projected to go up a little bit. So a return to surpluses, hopefully in about 3 years' time. So not technically not helpful for the Reserve Bank, but pretty small in the whole scheme of things. It's, not really something that will greatly concern the Reserve Bank.
So housing, I left it to last, and I know you've been doing lots of work around this, but what's happening?
Yep. Housing markets move in cycles. We have had the mother of all weird cycles over June 2020 through to November last year, with house prices soaring about 45% or so to ridiculous levels. And now there's a reality check / correction underway, which means prices on average have fallen 6% so far. Even if they fall 20% from their peak, if these were the old days, we'd be saying, holy cow, a 20% fall in prices, New Zealand's munted. No, it only takes prices back to where they were at the start of 2021. It's hard to take it seriously generally, apart from maybe some people who paid too much approaching the peak of late last year. There'll be some property developers who definitely paid too much for their land, and so there will be some equity issues for some of those out there. And some people would have maybe obviously bought a property over 2021 and could find themselves in a negative equity position. I don't think that's going to be causing a wave of mortgagee sales around the country. Banks are mainly interested in, can you service their mortgage? Can you keep making the payments? Well, with high job security in New Zealand and accelerating wages growth, the answer is going to be yes, people can keep servicing these mortgages. So a key characteristic you really need for a proper rout in the housing market, and we only think prices really might fall 10 to 15%, you need a lot of distressed sellers. Well, the test interest rates have been so high, only a few people will end up paying an interest rate higher than they had to prove they could service when they took out their mortgage 6, 12, 18 months ago. High job security is an insulating factor. Construction costs still rising is an insulating factor for prices as well. And as the Reserve Bank stated in their monetary policy statement, a lot of the consents which have been issued are not going to be acted on. These places are not going to get built. And therefore, talk of an oversupply situation, making people get even more cautious about buying, it's not really going to be seen in reality. But here's the thing. My prime comment at the moment is that people are going to actively look for reasons not to buy for the rest of this year. Even though they want to buy, they're still looking for their first home or an upgrade or whatever their policy. They're going to look around and go, I'm not going to buy because there's talk of brain drain. And so people, that'll push prices down. I'm not going to buy because I heard somebody talk about oversupply in Auckland. That's the part of the cycle we are in now. Psychologically, buyers look for excuses not to transact. What does that mean? we know that there's a big backlog already of people that want to buy. By the time the housing cycle turns, let's say it bottoms out the middle of next year, the stack of people looking to buy will be even bigger than it is at the moment, and there'll be a bit of a catch-up phase on buying. So the main piece of advice I've got to give, especially to first-home buyers at the moment, is do not try to pick the bottom of the cycle. I can't really do it. You can't do it. If you do, good luck. If you do it twice, tell me, I'm going to hire you. Focus on the fact that the number of properties available for sale has increased tremendously over the past few months. There's a very good chance you're going to be able to find the property with the attributes you want, but not necessarily the price you want, and be prepared to miss the bottom by 5-7% or so. Don't sweat that out. After a few years, it really won't matter a damn. Look for the property that best suits your needs. And ultimately, everyone is going to be walking this way away from buying. Give thought to the Warren Buffett method of investing. Walk the other way. You get the best, not bargains, but the best purchasing in that environment.
And look for the house that you want and that has a long-term play for you, and that's that sort of goals part that I mentioned before. So there's opportunity in the mist. It is a very unusual time though, Tony, isn't it? It's very it is destabilizing for some. I was just talking to a prefabrication building company owner down this morning getting a coffee, and he said that the building sector is in for a rough ride. There is the supply constraints, things like getting nails, basics, not just jib. It's nails, it's door handles, it's everything, and then labour on top of that, and the construction squeeze and getting finance for those guys. So yeah, interesting times ahead. But as I said, I think a little bit of a case of long COVID and biting us in the bum, so to speak. But yeah, there is some positives, and as you say, unemployment is at record lows. We've got some stabilising factors, and we need to keep smiling. So, look, thanks, Tony. I will say it like I say every month. Tony is an independent economist. His views are his own and not necessarily those of NZHL, and we like it that way. So, do fire us through any questions. I would say that Tea with Tony every month is evolving. We do tend to sort of discuss some of the things that are ahead of the trend, and then they'll kind of happen and we'll reflect on them. So it's quite a nice place to be. Okay, Tony, well, nice to see you again, and we'll do it all again, as I said, in person at some point